Why Benjamin Graham's philosophy still holds true today. We all know how the stock market can sometimes seem like a chaotic place, filled with buzz around the latest hot stock picks, influencers recommending the next big thing, and constant noise about short-term profits. But what if I told you that investing isn't about chasing trends or quick wins? It's about being patient, disciplined, and investing in a way that will provide steady growth over time. Benjamin Graham, the father of value investing, is the one who taught us these timeless principles. His philosophy isn't based on guessing or predicting the future. It's about making smart, well-informed decisions grounded in fundamental analysis. Even in today's fast-paced world of social media and instant information, his methods are more relevant than ever. Let's break down Graham's strategies and explore why they still work. Investing vs speculating, the key difference. Let's start with one of Graham's most important ideas, the difference between investing and speculating. Many people get these two terms mixed up. They think investing is just about buying stocks that are trending, but that's speculating, not investing. Investing means you buy something because you believe it has real, lasting value. You've done your research, and you know that the asset has strong fundamentals and will likely appreciate over time. You're in it for the long run. Speculating, however, is buying something based on hype, hoping to sell it at a higher price in the short term. It's risky, it's emotional, and often it's driven by FOMO, fear of missing out, rather than smart analysis. Graham made it clear that to be a true investor, you need to thoroughly research before putting your money into something. If you're not careful, you might end up just speculating, hoping to catch a lucky break. The margin of safety, your investment cushion. One of Graham's most powerful principles is the margin of safety. This is your buffer zone. It's the difference between what you believe something is worth and what you actually pay for it. Imagine this: you want to buy a house. It's priced at $5,000,000, but after researching, you discover it's actually worth $7 million. The $2 million difference is your margin of safety. It's a cushion that helps protect your investment in case things don't go as planned. When it comes to stocks, Graham advised investing in companies whose market prices are significantly lower than their intrinsic value. This margin ensures that even if things go wrong, you still have a safety net. In today's market, finding those kinds of deals can be challenging, but it's not impossible. The key is to be patient and do the research. You want to buy stocks that are undervalued but have the potential to grow in the long run. The Mr. Market analogy: don't follow the crowd. Another core idea in Graham's philosophy is his famous Mr. Market analogy. Mr. Market represents the stock market itself, a highly emotional, unpredictable character. Sometimes Mr. Market is extremely optimistic, and he offers to sell you stocks at ridiculously high prices. Other times, he's depressed and offers stocks at rock bottom prices. Graham's advice: don't let Mr. Market's mood swings influence your decisions. Instead of getting caught up in the market's short-term ups and downs, focus on the long-term value of the business. If Mr. Market offers you a stock at a great price during a period of pessimism, you should consider buying. If he offers an inflated price during a period of optimism, you might want to sell. The key takeaway here is that you should never follow market trends or emotions. Instead, stick to your strategy and invest in businesses that have real, lasting value. The net strategy: finding deep value. One of Benjamin Graham's most aggressive strategies was the net approach. This is where you find companies that are trading for less than their liquidation. Value the value of their assets if the company were to be sold off today. This is a more advanced strategy that involves calculating a company's net current asset value, NCAV. The formula is simple. NCAV equals current assets total liabilities. If the stock price is below 67% of the NCAV, Graham believed it was a strong opportunity to buy. In other words, you're buying the company's assets for a fraction of their value. This is deep value investing, and it's one of Graham's most effective strategies. Though not as commonly used today, it's still a great example of how Graham sought undervalued assets, even when the market was blind to them. Warren Buffett: the evolution of Graham's strategy. Now, let's talk about Warren Buffett, perhaps the most famous investor who learned a directly from Benjamin Graham. When Buffett started, he strictly adhered to Graham's value investing principles. But over time, Buffett evolved the strategy. While Graham focused heavily on buying undervalued stocks, Buffett shifted to focus on quality businesses with a sustainable competitive advantage. Think companies with strong brand recognition, loyal customers, and pricing power. Businesses that could continue to grow and provide stable returns for years. Buffett didn't completely abandon Graham's teachings. He still adhered to the core principles of value investing, particularly the idea of having a margin of safety. But his approach added an extra layer, investing in high-quality businesses that could withstand market turbulence and provide steady growth. Building a portfolio with Graham's principles. Building a portfolio using Benjamin Graham's principles is all about being disciplined and sticking to a plan. You can take two approaches to this. One, the defensive investor's portfolio. This approach is for investors who want a low-risk, low-maintenance strategy. You'll want to balance your investments in a way that provides growth without too much effort. A sample defensive portfolio might look like this: 50% in index funds, like the S&P 500, for broad market exposure. 30% in large cap stocks, big, well-established companies. 20% in bonds for stability and steady returns. This approach keeps things simple, low risk, and diversified. 2. The enterprising investor's portfolio. For those who want to take a more hands-on approach and spend more time researching, Graham's enterprising strategy is more suitable. This is for investors who are willing to put in more work to find undervalued stocks and take advantage of market opportunities. Here's an example of how you might build such a portfolio. 40% in value stocks, companies that meet Graham's strict criteria, low P or E, low P or B, and a solid balance sheet. 30% in growth stocks, companies with strong potential for long-term growth. 20% in special situation stocks that are undervalued due to temporary issues or economic shifts. 10% in cash or bonds to take advantage of opportunities during market corrections. This approach is more active and requires more research, but can offer higher returns. Benjamin Graham's investment philosophy is rooted in reason, patience, and long-term thinking. While the stock market has evolved since Graham's time, his principles remain highly relevant today. Whether you're a beginner investor or an experienced professional, the core ideas behind Graham's strategy provide a reliable foundation for building wealth. Key takeaways: invest in businesses, not just stocks. Apply a margin of safety when making investment decisions. Don't follow the market's mood swings. Focus on fundamentals. Stick to a long-term, disciplined strategy. So, take these timeless strategies and start implementing them in your own investments. Remember, intelligent investing is about staying rational, keeping emotions in check, and letting time work in your favor. By following these principles, you'll be well on your way to achieving long-term financial success. Thanks for watching. If you found this breakdown of Benjamin Graham's investment philosophy helpful, don't forget to hit that like button and subscribe to the channel for more insights on smart investing and financial strategies. Got any questions or thoughts on Graham's principles? Drop them in the comments below. I'd love to hear your take. Stay tuned for more content. And remember, invest smart, stay patient, and keep growing your wealth.